Okay, well, welcome. Welcome to our webinar. This series focuses on individual taxation. We have a series that focuses on business taxation as well. So today we are going to talk about one of the most popular inquiries that we get here at the CPA firm, which is how the heck do I reduce my high W-2 income tax, right? So if you're a single person with making a good amount of money, you're probably paying more taxes than anyone. And so this webinar is for you. So you know what is possible to reduce your taxation. Right now, you want to seize the opportunity for 2026. Even though it's the end of July or the start of August, there is still time to implement some of these strategies and making a meaningful impact on your tax liability for 2026. The key is proactive tax planning. The key is forward, planning to hit the mark on legal strategies ahead of time. Here's how the tax business works, right? You may talk to your tax advisor only during tax time, right? And what's happening during tax time? Every tax office is overwhelmed. Every tax office has people that are doing so much work. There's no time to talk about strategy during tax season. In addition, last year is cement. We cannot go back and alter bank statements, W-2s, 1099s. That is cemented financial reporting. So you want to think about your tax year contemporaneously as things are unfolding. All right, so who you have on the webinar today is myself and John. John, will you tell us a little bit about yourself?
Hey there, John Hannum, CPA and former CFO, corporate strategist. I spent my years in corporate America building companies and growing companies and keeping companies out of financial mishap, making some great financial decisions. And now, with Privity CPA and partnering with Stephanie and her great tax knowledge, we help business owners, real estate investors as well, look beyond this just accounting to really use their numbers for the power of good.
Thank you so much. So
Thank
happy
you.
to have be on the team with you, John. My name is Stephanie Anderson. I'm an enrolled agent, which most people don't know what that is. It's another topic. Certified tax strategist, and I have a master's of science in taxation, and I'm very passionate about proactive tax planning.
I can attest to that.
I love it. Okay, and just to let you know that attending our webinar, watching this does not constitute a professional relationship. This is not an engagement. To be our client, you sign an engagement letter, pay a retainer, then you're officially our client. So if you're watching this, this is just for educational purposes only. The tax law and tax planning is all facts and circumstances specific to that taxpayer. So we're going to talk about broad, roomy, general ideas so that you can be informed of what you may not know in order to make tax smart decisions. Okay, so how can high W-2 earners legally slash their tax bill? I'm going to give you the top 3 ways today. Here's the problem for the W-2 wage earner. You have no flexibility, no control. You're issued a W-2 at the end of the year. You cannot write anything off of that. And you have the maximum exposure. You start hitting top brackets, the NIIT tax, and honestly, you are paying more taxes than business owners and real estate investors. There are 400 legal tax strategies that I study at a tax planning institute. Most of them, most of those are for real estate investors and business owners, right? The tax law shapes our economy. And people have power and influence over this. And it's the business owners and the real estate investors that have most opportunity. The tax, you know, Code 61, one of the original tax codes, it said everything is subject to tax. That's how we started out. And in the United States of America, one of our highest tax rates was 95%, and that happened during a war. But this is a, wild, wild west. If you can pay less tax, that is the foundation of growing your wealth. So that we have Code 61 that says everything is taxable. And then after that, you have tax court cases, you have other primary source that comes out of our government. And what those are blueprints to say what's an exception to Code 61. That's what tax planning is. So if you have a high tax confidence level, a primary source citation that we know what the tax court or the IRS is going to rule on something, we're going to follow that, right? We're going to say, okay, here's the mark I need to meet, and I'm going to proactively meet that mark. And in the process, you're going to have contemporaneous substantiation, because what matters, there are so many wrong and sloppy tax returns that are filed that go under the radar, but those days are over, right? We have AI now. The IRS has 100 AI projects. It's going to be able to check all tax returns in the United States of America, and then the beautiful supercomputer is going to send you a love letter, right? So what matters is, can I substantiate the tax position on my return? That's what matters. So let's talk about how we can do that for high W-2 wage earners. Everyone knows strategy number one, which is to kick the can down the road, right? I'm going to put money in my 401k. I'm going to save a little tax this year. But down the road, you're going to be sitting next to me at the desk and going, "Oh my gosh, I'm retired now and I'm paying all these taxes," right? And can you predict what the tax rate is going to be at that time? I just mentioned that the highest tax rate we ever had in our country was 95%. Do you think that we're going to get more fiscally sound as a country and tax rates are going to come down? Who knows? I mean, you need a crystal ball to know. So you're kicking the can down the road on this one. Right, John, did you want to add to retirement?
That's exactly right. You never know. Obviously, the idea is that when you're retired, you'll be not drawing your massive W-2 income. You'll replace it with a smaller stipend that should handle you through retirement, maybe some Social Security if it still exists. All of that, and so your income lower level will be lower, and you'll theoretically pay lower tax. But my crystal ball is just as broken as yours, Stephanie. So who knows what that looks like? And maximizing your 401k or your deferred compensation now will take your tax liability down now, but there are obviously caps that you're going to talk about and all of that. Um, the Roth might be a balancing between the Roth and the traditional idea of an IRA or 401k would be interesting, because the opposite is true on the Roth, and that all of the gains would be not taxable, but you're not lowering your tax liability now. So yeah,
That's correct.
I like to employ this one. I tried to max out all of my investments and reduce my taxable liability as much as possible when I was a W-2 earner. So it is a valid strategy, and it's very useful.
And it's an easy one. It's an easy one that you can do just on your own. And if you're working with a financial planner who is guiding you on how much you need in the various accounts, that's great. We, as tax advisors, do not tell you how much to put into here. We only can talk about the tax implications of these various things. And we do assist in doing mega backdoor Roth conversions, all those kinds of things we will address in tax planning. But this may be one area where you want to also use a financial advisor to plan for retirement.
Can you
So
do
we're at
this? Can you
hmm?
do this now, Stephanie? What's the timing? I'm not sure if you addressed that, but like, is there any opportunity to lower, if I haven't done my 2025 taxes yet? can I still put money into any of these ideas until the deadline of 10/15?
Well, it depends. It depends on a lot of circumstances. So I don't know that we have time to go into that today, but if you would like us to look at your specific situation, we can do that. I do have business owners that ask me about that all the time. And, did they already have an account open, right? So sometimes, you open the account and you don't fund it until you know what your tax liability would be later. But if you're a wage earner, those contributions have to be contemporaneous with getting paid. We cannot amend payroll to go back and make retirement contributions. So again, the best way to get the best tax result is proactively throughout the year and contemporaneously as transactions occur. All right, so most people are doing this, at least in our firm. Most people are on track with this. So I'm not sure that brings a lot of value to our clients, but let's talk about strategy number 2, which is called the short-term rental tax loophole, right? All real estate is deemed passive unless it meets an exception. And this is one of the exceptions where the average stay of your tenant is 7 days or less. Why is that important? If you had a loss on a short-term rental, if you had a loss on a long-term rental, you can't use it against high W-2 wages. There are caps, right? Depending on your filing status. If you exceed a certain modified adjusted gross income, that loss is suspended, it's stuck, and it carries forward on your return, and you probably won't be able to use it until you dispose of that property. So in tax planning, we call that harvesting NOLs, harvesting net operating losses, right? So that can be a complicated topic. But if you're a high W-2 wage earner and you have enough time and money to start a short-term rental, then you can start to maximize that short-term rental by creating losses. And you can legitimately do this. I'm not talking about manufacturing deductions or making something up. Of course, we wouldn't say that. But you could add a cost segregation study to that short-term rental, right? And that accelerates depreciation. So if you have a residential real estate property, you take the cost of that property, you back out land, right? Because land is non-depreciable. And then what's remaining, that is depreciated over 27 and a half years. But there are components of that building that do not last 27 and a half years. And so you get an engineering study and you break it out to different class lives. And then if it's the first year, then we can just go right on the depreciation schedule with those numbers. If it's been more than 2 years, then we have to do an accounting change. And that is a separate tax work packet that gets sent to a different IRS office separate from your tax return. And then we do a 481A adjustment on Schedule E. Very complicated, kind of technical tax work. But you don't have to worry about that because you're going to use a tax person to do all of that reporting for you, or God, I hope you do. Get it done right.
Sure.
There's so much of this information flying around the internet now that there's a lot of sloppy work. There's a lot of undefendable cost seg studies. So you want to make sure that who you're working with it has got high integrity, that they don't have, a lot of audit in the background, and that you can defend this position. But this is extremely powerful. So let's say that you have $300,000 on line 1 of your tax return. That's all W-2 income, ordinary income. Then on a different line, you could potentially have a negative 80,000 or a negative 100,000 based on, potential, the value of the short-term rental, and really bring down your modified adjusted gross income. And then that's going to pull down other numbers and other factors on your tax return. You could be, paying less additional Medicare tax, less NIIT. You never know. It really works together. So I'm sure some people have heard about rep status, real estate professional status. Real estate professional status would be if you had multiple long-term rentals. I like to have at least three in a rep status, right? So you meet the mark on all of those, and now all your long-term rentals can be considered active. But not everybody can have three long-term rentals. So if you can go with one short-term rental, you will get the same results or similar results. So these are the various things to look at here. I talked about the cost segregation study, which is reclassifying some building components into different class lives. Instead of, a 5-year property depreciating over 27 and a half years, you get to take it all in 5 years. You meet the material participation tests. Um, yeah. So what happens here is that it really depends. You have to have the best record keeping. And one trick that I'm going to share with you is that if we're going to implement this strategy, either the reps or the STR, you're going to keep a traditional time log, pen and paper. Go to Staples, get a planner, you got a pen and paper. At the end of the year, you're going to put that in a FedEx or a UPS, and you are going to ship that to the CPA office, right? Now you have an official time data stamp of when you made that log. And that log is only going to be opened up in front of an auditor. What you don't want to do under audit is get chosen for audit and then be frazzled to reconstruct and try to make documentation and substantiation at that point. They've seen it all. They know when you do that. So you have a better chance of winning if you do this contemporaneously and with that little tip that I gave you. Super old school right there.
Well, in fact, if you make it up afterwards, it's just tossed out by the IRS. If it's not contemporaneous, even if it's valid, even if you've constructed things, your record to be exactly right, unless it's contemporaneous, the IRS will not allow it in audit. You have to keep contemporaneous records.
That's a great point, John. People do not know that is the law. Like we are required to keep contemporaneous record keeping, accounting, time logs, mileage logs, all of that.
Yeah.
So you have to
Case
consider that. Are you that type of person? Otherwise, this strategy may not be for you, right?
case after case, those anything created after the fact is thrown out of court. So it's as an enrolled agent, obviously you represent people in front of the IRS. So you know that, but that's things I've learned in the last few years of understanding tax at a deeper level. It's really interesting.
Yeah. So the mundane, and we can give you tips on how to do that, on how to keep contemporaneous records, or we could keep them for you. So strategy number 3, one of the most misunderstood things out there. Let's clear it all up right now. This is powerful stuff that you can do year after year after year. So first of all, we need to understand what an accredited investor is. I deal with some really financially savvy people, wealthy people, affluent people, and I'm surprised that they don't know what this term is because it comes from the SEC right here. John, would you like to talk about what an accredited investor is?
An accredited investor is somebody that actually has an accreditation because of their investing status, which is specific to their net worth or their income. You have to have accumulated net worth of more than $1 million in assets that does not include your primary home. So otherwise, everybody in California would be an accredited investor with all of our expensive homes. You either have to have accumulated $1 million in assets and net worth outside of your home, or you have to meet some income uh, attributes each year. So once you get that accreditation and you write it down into a letter, you have somebody that says this person has a net worth that's higher, or this income is higher, and we do sign those quite often as CPAs. We check that and say yes, you're an accredited investor. then you can actually be an accredited investor. Until then, you're kind of locked out of some interesting investments.
So it's much easier for us to sign that form or to know if you qualify. If we just look at the last 2 years of returns, if you're an individual person, 200K or more in line one, Mary filing joint, 300K or more in line one of your return. Boom, super easy. Black and white, the facts are there. If we have to start tracking down assets outside of your primary residence, your stock portfolio, your retirement account, then this is a little more work involved here. So if I pick up a tax return and I see this, I'm going to proactively reach out to that person because 99% of the time they have never heard of this and they don't know what it means. What it means is that a whole world of tax planning has opened up for you. Here is example number one. Not as popular in California, but it happens. This strategy has been around for about 80 years. Oil and gas working interests. You know how the rich and powerful can influence law in our country. And the oil industry is quite rich and powerful. So there are specific tax credits and deductions associated with these investments. Intangible drilling costs. So if whatever amount you put into year one, you automatically get a deduction, and it can range depending on what investment is open at the time. If you're an early bird investor, sometimes they have some really high ones at the top of the year, 92%. And as the year unfolds, it starts going down to 82%, 80, but 80 is still really good. And then what happens is that is probably going to cash flow for the next several years, and you'll have money coming back in, which is reportable income, but it's reduced by 15% for the depletion allowance. Okay, and it's not subject to NIIT. They're excluded from the passive activity rules, right? So when you're doing taxes, you have to understand what kind of tax it is and whether it's passive, whether it's portfolio income, whether it's ordinary income, whether it's active. All of these things come into play. So this is a real easy one that hits all the marks on this. And we have clients that do it year after year. Number two, pass-through benefits, right? I'm not giving you a very specific example because it just depends on what's available, what kind of investments exist out there, but you can get a K1 coming through, and based on different attributes of that particular entity, you can have negative numbers flow on your 1040. Very complicated. You have to understand basis, you have to understand the entity type, levels of partnership, what kind of partner you are, all of these things. But there are investments out there that specifically can bring negative numbers onto your tax return. Okay, number three, let's talk about clean energy. Clean energy is solar, basically. And there's $30 tax credit for commercial solar projects. So here are some of the numbers, right? Now, these are passive. This is not automatically an active investment, meaning that it's not going to automatically go against your W-2. So if you have passive income that you want to offset, this is a really easy, wonderful way to do it. If you want this to be active, you would have to actively work on your solar project to meet the material participation test, and that would mean 100 hours or more. And we do have clients that have actually flown all around the country together to work on these projects. It's so cool when the clients meet each other. So these are just examples. It's not to promote any particular example, but to show you what's possible. Bonus strategy, not for everyone, obviously, but buying in a hotel. buying a hotel is a home run, a run on reducing your high W-2 wages. And the very nature of hotels is that the guests are staying 7 days or less. And you have all kinds of assets within a hotel to depreciate. So if you have that kind of money, maybe not here in Ventura County or Los Angeles County, hotels are a fortune, but perhaps in other states, right? This could be a real easy win.
Mentioned cost segregation too, and how you should partner with a good cost segregation person. So, part of the contemporaneous uh, documentation that you'll need to produce if your cost segregation is questioned is that study. So you obviously keep it safe. You put it in your portal if you're a Privity client, and we keep it safe for you. But it's there, and it definitely has to be believable. So you have to have somebody. You can't just go through and have your cousin say, yeah, that's worth 50,000 and that's worth 100,000. Really documenting and knowing that it's audit proof is key with those cost seg studies. And the hotel, that's a big powerful idea, because there's a lot of stuff, as Stephanie mentioned, in hotels that is depreciable at a different life, and it moves it out of that 27 or 39-year category um, back into a 5-year category, and gives you a huge write-off against your first year income.
Yeah, and maybe you can't buy a hotel yourself, but maybe four people can, right? And pass that through a partnership. But this, with anything in tax, okay, so part of what you do as a tax planner when you're implementing this for your clients and you're coaching them and you're guiding them through and you're making all the documentation, because I'm going to be the one defending this, right? I don't work with all vendors. I don't work with just anyone who offers an oil and gas or cost seg or solar or any of these things. They have to be vetted. And there are a lot of things to look for on that. In ever since the internet and social media, and there is so much out there that's not defendable. So being able to practice discernment is of utmost importance. Under audit, you must be able to speak and write in tax confidence levels to that auditor or to that attorney that's representing the IRS or the Franchise Tax Board. These guys are attorneys, right? So you have to be able to read and write and speak and defend in tax confidence levels. And if you're trying to figure out who to work with, what tax planner am I going to work with? What vendor I'm going to work with? What cost seg company am I going to work with? You could just easily ask them, what is your tax confidence level? Do you have that documented? Have you ever had to turn that in before? And I would bet money that 85, almost 90% of people aren't going to know what you're talking about. And that's terrifying. So these are being able to practice discernment and know what's safe in the world of tax is a whole nother world. And so as a tax advisor, that's my job. That's my job, and to protect the clients. And so if I say a cost seg makes sense for you in these sets of facts and circumstances, then I'm going to bring a cost seg company that I know and trust. I'm not going to just go on the internet and pick one. You can ask around and you'll see there's all kinds of companies, and you know self-use calculators online for low cost, $99. No, no, we're not doing that. Okay, so now you know what's possible. You can put money in your 401k. You can get a short-term rental. You can get a hotel. And if you're a accredited investor, there's a whole world of investing that has attributes, right? Attributes that bring down negative numbers on your tax return. And when you run all the numbers, you have more money in your pocket for doing it than for not doing it. That is the radical thing about it, is because of the tax attributes. If you look down, let's say I went this way and I didn't do any accredited investor strategies, and I just paid full tax on my W-2 income, you can come up with a number, right, of how much money you have left. After 5 years, you can run projections. But if I go this way and I do one accredited investor strategy, I can also run the numbers on that. There's always more money in your pocket. In my experience with the things that I've done, there's always more money in that client's pocket, even after paying the tax planning professional fee to make it, you know, to have us coach you and get it done right. There's always more money in the pocket. So it's just a no-brainer. Do you want to have more money in your pocket or don't you? It's just a no-brainer. The thing is, no one's ever presented this information to most clients. Most tax offices are doing such high volume tax returns and after the fact and chasing the next deadline that they have no way, no capacity to bring this to their clients. And number two, knowing this information is not required to get your license. It is not required to become a CPA. It is not required to become an enrolled agent. It is not required to be a tax professional. This kind of high-level tax planning, being able to do it correctly, is a whole nother field of education that is optional. And again, most people don't do it because they're working 80 hours a week just doing tax returns, sales tax filings, payroll filings, tax returns, accounting. There's no capacity for this. So I had a shift in my particular practice in 2021. I started studying this in 2018, but in 2021, I made a real shift and I started doing significantly fewer tax returns and spending more time in this type of area. And it's such a fun engagement because the clients, they're learning and they're getting excited and they're making tax start decisions. And if you work with them for a couple years, they start having more money in their pocket and they start reaching some of their other financial goals. Maybe they want to get a rental, or maybe they want to retire at a certain time. Or I've had so many clients that wanted to start a business but were too afraid to. They were paralyzed by fear. And once they got their tax plan and they learned what was financially possible just by having a business, that completely changed their life and have started businesses. And this is what's so exciting to me about the tax law is like, if you actually follow the primary source citation and you follow what the tax law says, it's your life can get a lot more exciting and you can have a lot more money and it can help you attain your goals and your dreams. It's done that for me, and I've enjoyed being part of that journey with the clients. So if you are ready for a personalized tax assessment, we are ready. We are ready. So what we would need is we would need some data collection, right? We would need to see preferably the last 3 years of returns, only because of the RSED. If we find mistakes where we can amend for a refund, there's a 3-year limitation on that. Most clients can't get us 3 years. So we will take 1 or 2 years of past filings. We also need to have a snapshot of what's true today, of what's happening today, right now in 2026. And we need to know a little bit more about you and your facts and circumstances. We need all of that information, and then we can put together a tax assessment and let you know what is possible. My question to you is, are you truly convinced that you are paying the least amount of tax possible? And if you are, how did you come to that conclusion? How do you know? I don't think you can know unless you have studied tax. I don't think you could know. You're just trusting what other people say, right? Wouldn't you like to know for sure that you are not overpaying your taxes? Most people come to us and say, so and so doesn't pay any tax. So and so doesn't pay any tax. How is that possible? I'm paying so much this, and that. People are agitated by this. They're angry by this. Wouldn't you like to know once and for all what was possible for you? All right. Well, that was everything that I wanted to share on that topic.
One of the reasons I love partnering with you, Stephanie, is your passion for this, and I've known it over a very long time. So I am very, very passionate about business growth, making good financial decisions, buying and selling companies at the right time, doing good accounting because none of this happens without good accounting. And Stephanie, I love your passion on truly deep tax planning, building plans that survive audit and um, scrutiny of any type. So I love doing this with you, and I learn something every webinar that we do together too. So really appreciate that.
Right back at you, John. Ditto.
Great. Mhm.
Wonderful.
Don't see any questions in the question box, but happy to entertain questions at Privity CPA. So my email is johnjohn at privitycpa.com. Stephanie is her first name at steph at privitycpa.com. Our website is privitycpa.com. And we hope that you reach out to us if you're not a client already and get into this great firm that offers so much more than a traditional CPA firm. With that, I guess we say thank you. And Stephanie, anything else you want to wrap up with?
No, I'm ready to get to work.
Have a great day, everybody.
You too. Bye-bye.